Hey there, Brad Castro from GreatOptionTradingStrategies.com. In this video, I'm going to talk about how to avoid catastrophic option trading losses. So online broker TradeKing has posted their top 10 option trading mistakes that beginning option traders make. And you can find a link to that article below this video. Now, the purpose of this video isn't to critique the TradeKing list, but rather to take a step back and look at the bigger picture. Obviously, no trader wants to lose money, but the larger issue here is how to avoid the really big option trading losses, the catastrophic losses. In my view, there are basically three categories of catastrophic risk in the stock market. Number one, a truly catastrophic, civilization-ending macro event like nuclear war, collision with a giant asteroid, massive zombie outbreak, or an alien invasion and conquest. Number two, investments in structurally vulnerable businesses. Number three, self-inflicted and structurally disadvantaged trades. For the purpose of this video, I'm going to focus on that last one. Now, if you're more investor than trader, you can check out this video to learn more about using and expanding through the use of options Ben Graham's margin of safety concept to protect your investment capital. Self-inflicted option trading catastrophic risk. Now, the TradeKing list on the whole includes some good advice, but their article doesn't make a distinction that I think is important and often overlooked: minimizing risk versus avoiding it altogether. Inside the Leverage Investing Club, I teach a primary customized option trading strategy that I consider to be structurally advantaged for 4 reasons. Number one, it consistently generates high-yield income, which can then be used as a means for the low-cost basis acquisitions of high-quality businesses. Number two, it compensates me for exposing myself to volatility rather than risk. Big difference. Number three, it provides easy to understand terms so that I can choose trades where even the worst case scenario still produces favorable results. And number four, it's flexible enough that I can almost always renegotiate the terms of the original deal, and multiple times if I so choose, so that I'm able to continually improve those worst case scenario results. Avoiding option losses by avoiding structurally disadvantaged trades. Not to be too binary here, but by definition, any trade that isn't structurally advantaged must therefore be structurally disadvantaged. For example, if I'm in a trade where at some level I need to be right about what a stock share price is going to do in the short term, I'm putting myself at risk. That doesn't necessarily mean that I'm trying to pinpoint exactly what a stock is going to do. But if I need it to be somewhere over here, or I need it to not be somewhere over there, or else I'm going to lose money, that's a potentially catastrophic risk to which I've exposed myself solely from my own actions and decisions. Now, self-exposure to potential catastrophic risk comes from 2 different sources: the strategy itself and through some form of over-leverage. Often these factors overlap. For example, I could write a single cash-secured put at the $40 strike price, meaning that I receive a cash premium payment in exchange for, at some level, agreeing to put aside $4,000 to buy 100 shares of the underlying stock in the event that the stock falls in value. Or, using the same amount of capital, I could write 8 $40 to $35 bull put spreads, where for every short put I initiate at the $40 strike, I buy a corresponding long put at the $35 strike. The maximum gain is achieved if the shares are trading at or above $40 at expiration, and the maximum loss is achieved if the shares are trading at or below $35 at expiration. So, if the stock falls to, say, $36, I'm totally screwed with the bull puts. That is, unless I have, and/or I'm willing, to pony up $32,000 in cash or margin to convert those bull puts back into cash-secured puts. Otherwise, it's just too difficult and expensive trying to adjust and repair underwater bull put spreads. In order to roll an in-the-money position involving short put components to lower strike prices, it gets very expensive to also have to roll long puts as part of the process. Not so with a cash-secured put. The best case scenario is I'm still able to adjust and continue adjusting the position in my favor over time. And the worst case scenario, assuming this is a high-quality company that I liked at that price in the first place, is that I didn't get as good of a deal as I could have. Huge difference then between how I set up the 2 trades. If I get greedy and over-leverage, I can bring about my own catastrophic risk. Many option income traders, knowingly or unknowingly, assume these elevated risks. The conventional approach is to minimize the risk by using small position sizes or to have very disciplined rules about cutting losses early. Myself, I think it makes a whole lot more sense to avoid the risk altogether rather than attempt to take something inherently risky and minimize it. I know this is an unconventional view. That's because it's not a trading perspective. It's an investing perspective. But in my opinion, as someone who uses options to make me a better investor, not a riskier trader, the risk of catastrophic losses based on how one trades is something that can and should be avoided in the first place.